Hello everyone, good morning and welcome to Advanced Audit and Assurance Revision Revolution session. We already finished the first session wherein we stopped at reporting. Okay, so we did a few issues and then we stopped at recording. Now we're going to continue from there. So let me share the screen with you. I hope your studies are going amazing. Okay, so this is where we stopped last time, which was the lecture that we had on Saturday. Okay, so this is the exam focus of reporting, and you really need to focus on these points in reporting. So one of the questions in the exam will focus on completion and reporting. Reporting may be examined in several ways. So reporting ये जो है auditors report and reporting may be examined in several ways. You may be asked to describe the implications for the auditor's report if issues identified during the audit are not resolved. I told you the management will have two options. When you as an auditor tell the management to resolve the issues, step number 1, the management will listen to you and resolve the issues. If the management listens to you and resolves the issues, the matter gets over there and there. But if the management says that I'm not going to listen to you, I'm not going to solve the issues, I'm not going to report the issues, then what? So then is what the next picture starts. Critically evaluate extracts of a draft report, that is, say what is wrong with it and explain why. Whenever there's a draft report, you have to evaluate that. Now, in the first lecture on the ACCA Study Hub, I showed you the difference between evaluate, describe, criticize, define, and all of that. You have to evaluate extracts of a draft report, that is, say what is wrong with it, that is, what is wrong with the draft report, and explain why that is wrong. Explain the matters the auditor should communicate to those charged with governance. So what are the matters that are very important that needs to be communicated with those charged with governance? These are the exam focus points of reporting. And audit reporting additional communications. Now what are the additional communications that we have? In certain circumstances, auditors are required to make additional communications in the auditor's report even though the financial statements show a true and fair view. So it's not that always that if the financial statements show a true and fair view, the auditor doesn't have to say anything. See, although if you're preparing the financial statements properly and if they even show true and fair view, there might be certain matters that auditor would wish to communicate to the general public. Issues requiring communication include, so although your report is correct, your report is same, you've made everything according to the applicable financial reporting standards, but still there is something extra that the auditor needs to communicate to those charged with governance. So what is that little bit of extra thing that although your report is true and fair, the auditor would like to tell general public? Material uncertainty relating to going concern. If the auditor feels that the financial statements are perfect, they are prepared correctly, but there are certain material uncertainties that the auditor feels with pertaining to going concern, so that the auditor can report. Emphasis of matter or other matter. Emphasis of matter means all that is there in the financial statements, but the auditor wants you to emphasize on that, to think about it. So that is put in emphasis of matter. Other matter paragraph. Other matters other than those stated in the financial statements that the auditor feels need to be communicated with you. It is important to note that these do not impact the wording of the opinion and do not constitute either a qualified, adverse or disclaimer of opinion, because the financial statements show a true and fair view. These are just the additional communications that the auditor feels that you need to know. Like, for your knowledge, you need to emphasize on this matter. For your knowledge, you need to know that there are certain material uncertainties relating to going concern. For your knowledge, there are some other important matter paragraph. But along with these paragraphs, your impact on the wordings of the opinion does not change. Your opinion will still remain the same. If you feel that the financial statements show a true and fair view, then be it. Okay, so your wording is not going to change. What is going to change is material uncertainty relating to going concern, emphasis of matter, and other matter. Audit reporting. Now, the independent auditor's report. Independent auditor's report means, first of all, we know that the auditor always has to be independent because the auditor is appointed by the shareholders to go into the company on behalf of the shareholders and find out whatever is going in the company. So the auditor is always an independent person because he's not a part of the company. But still in the audit report, at the heading you have to mention that it is an independent auditor's report. When the audit work is complete, the auditor will prepare the auditor's report containing an opinion on the financial statements. So auditor will go into the company as an independent party. The auditor will audit the company, and after auditing the company, the auditor's report will contain an opinion. What auditor feels about the financial statements. And the objectives of the auditor are to form an opinion on the financial statements based on evaluations of the conclusions drawn from the audit evidence obtained. So basically the auditor has to form an opinion that okay, the financial statements show a true and fair view, or the financial statements do not show a true and fair view, and to express clearly that opinion through a written report. It's just not giving your opinion orally, because as I told you, we cannot trust facts that are said orally because oral facts can be changed over time. So you have to always give it through a written report. The auditor forms an opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Along with giving their opinion on whether the financial statement is true and fair, the auditor also needs to make sure that all these financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. They are done crisp, they are prepared crisp, they are prepared proper. So this is what is the independent auditor's duty. Along with stating that the financial statements are true and fair, they also have to make sure, and they also have to form an opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. So what is an independent auditor's report? This is an independent auditor's report. What will the title consist of? That it is an independent auditor's report. Then addressee, to whom you are addressing the report. Your end user, shareholders, stakeholders, other key stakeholders such as the wider community, whatever. Then what is the auditor's opinion? The financial statements show a true and fair view. Then basis for opinion. Just giving the opinion and getting over it is not enough. When you give an opinion, you have to explain why you're giving that opinion. So did you understand? It's just not like the auditor giving his opinion and getting done with it. You have to give your opinion and you have to give an explanation for why you're giving that opinion. Material uncertainty related to going concern if applicable. If during the audit you come to understand or you come to discover certain material uncertainties in the company that you feel need to be addressed, need to be told to the shareholders because it is an important matter, then do it below basis for opinion. Then for listed entities, you have to do KAM, key audit matters, emphasis of matter if applicable, if you want to emphasize on any matter. So the matter is already there in the financial statements, you just want to put your emphasis on that. Maybe you want to highlight that matter. Sometimes it is possible that you don't want to highlight any matter because all the matters are proper and they're not that worth of being highlighted. When we study from a book, we do not highlight all the parts. We highlight the parts only that we feel are important. And it's okay if sometimes in a particular chapter you don't feel anything is important. So similarly here also, if the auditor feels that that part is important, he might highlight. If he feels it is not important, he will not highlight. Other information, responsibilities of management. What are the responsibilities of the management and what are the responsibilities of the auditor? Why these are to be stated, responsibility of the auditor, responsibility of the management, so that there is no misunderstanding between the management and the auditor, because the auditor might say no, it is your responsibility, the management might say no, it is your responsibility. So to avoid the blame game, state their responsibilities. This is your responsibility, this is your responsibility. Don't argue, don't fight. And when you know your responsibilities and your scope of work in advance, you can prepare and design the audit better. Okay, so if you know that, okay, this is my work, this is my job, I can do it better. So that is why. Then auditor's responsibility, responsibility of the management. Report on other legal and regulatory requirements. If there are any local legislation, regulatory requirements, you have to, take them into consideration. It's very important. Other matters, if applicable, if you want to state something else which is not there in the books of accounts, but you feel that it is important for the shareholders to know about that, you have to put it in the other matters section. Signature at the end, and auditor's address. Address is not the home address, address of the office of the auditor, and the date on which you prepared the auditor's report. So these are going to be the contents of an independent auditor's report. Okay, these are going to be the contents of an independent auditor's report. Now, auditor's opinion. Here you saw that the auditor has to give his opinion, right? Where is it? Yeah. See, auditor's opinion. So what that opinion needs to be, how that opinion is going to keep on changing from situation to situation is what we are going to see next. So till then, please go through the independent auditor's report. Title, addressee, auditor's opinion, basis for opinion, material uncertainty related to going concern if applicable, listed entities, key audit matters, emphasis of matter if applicable, other information, responsibilities of management, auditor's responsibility, a report on legal and regulatory requirements, other matters if applicable in accordance with IIC 706, signature, auditor's report, and date. Signature is very important. It will tell you which auditor has signed the report. That means which auditor has checked the report. Tomorrow if some fraud uncovers, then you can exactly catch the auditor who audited it. Auditor's address and date. Next we have is auditor's opinion. How the auditor's opinion keeps on changing and what are the different opinions that the auditor can give. First of all, the nature of issue. Nature of issue are of two categories. One issue can be that there is a misstatement in a financial statement, and one issue can be the auditor is not able to obtain sufficient and appropriate audit evidence. So auditor is trying his best to audit the company, but there are so many things that are happening in between, so many rocks that are coming in the way, that he's not able to obtain sufficient and appropriate evidence to prove his point. And maybe the management is also not coordinating with the auditor. The management is behaving very weird. They are not giving them the necessary information, and the auditor is not able to obtain sufficient and appropriate evidence. So there can be two nature of issues. One is that there is a misstatement, and second is inability to obtain sufficient and appropriate audit evidence. Now the first nature of issue that we're going to see is misstatement. There is some kind of misstatement in the financial statements. Now, what is the definition of misstatements? Misstatement including omission is considered to be material if it individually or in aggregate will change your decision to invest in the company. That is misstatement. Now, if this misstatement is not material, it's not material, so there will be an unmodified opinion. The auditor will not modify his opinion and say that the financial statements show a true and fair view, because this misstatement is not material, so it does not affect the company. So if it does not affect the company, that means the financial statements show a true and fair view. Second, this particular misstatement is material but not pervasive. What is the meaning of pervasive, not pervasive? The matter is material, but it does not affect the entire financial statement. It affects only that area. That is known as non-pervasive. Only that area it affects. So the matter is material, but it affects only that particular area. It doesn't affect the entire financial statements. So for example, in a box of mangoes, there is a rotten mango, but that rotten mango is not affecting other mangoes. only that particular mango is rotten. That is the meaning of material but not pervasive. In this case, the auditor will modify his opinion and give a qualified opinion that except for this mango, all other mangoes are good condition. Except for this mango, all other mangoes are good condition. So except for opinion, that is a qualified opinion. Next, this matter, that is the misstatement, is material and pervasive. That means the mango is rotten and that mango affects the entire box of mangoes. So that issue, first of all, is material. That misstatement is material. Not only is it affecting that area, but it is affecting the entire financial statements. Because of that one rotten mango, all the other mangoes are being affected. Material and pervasive. In this case, again, the auditor will modify his audit opinion and say the financial statements doesn't give a true and fair view. That means the entire box of mangoes is rotten, because that mango is affecting all the other mangoes. So you give a conclusion that the entire box of mangoes is rotten. Okay, this is in relation to misstatement being non-material, material but not pervasive, and material and pervasive. Next nature of issue is inability to obtain sufficient or appropriate audit evidence. The auditor is trying his best in the company, but there are certain situations that are happening in the company, certain matters that are happening in the company, maybe the management is not cooperating, that we are not able to obtain sufficient and appropriate evidence. In this case, if this issue of inability to obtain sufficient and appropriate evidence is not material, then the financial statements show a true and fair view, because this issue is not material at all. Okay. But if the issue is material but not pervasive means what? Only that mango is rotten, it is not affecting other mangoes. So again, you will give a qualified opinion, that is an except for that matter, all other things are good. But if the matter is material and pervasive, that means that mango is rotten and that rotten mango is affecting the entire financial statements, but the issue here is inability to obtain evidence. So evidence is not there with us, so we cannot prove anything. We cannot say that the financial statements do not give a fair and true and fair view. In this matter of being material and pervasive, of inability to obtain sufficient and appropriate evidence like misstatement, we cannot give an opinion that the financial statements show a true and fair view, because we do not have proof to prove that opinion. So if we do not have proof but we know that the matter is material and pervasive, we will not give an opinion at all, because we don't have proof to prove our opinion. So we will give disclaimer of opinion, that is no opinion at all. Okay, we will give a disclaimer of opinion, that is no audit opinion at all. So I want you all to go through this, and then we'll quickly begin with the sums. Okay, please go through whatever we did. Till then, I'll quickly check the comments. If you guys have any doubts while you're watching the lectures on AAA, please let me know in the comments. Okay, now let's begin with the sums. We are going to do section B sums. Okay, so let's begin with section B sums. So before that, just revise the auditor's opinion. We're going to do very much on these topics that you should focus on, that is exam focus points. And to start section B, sums. So this is the first section B sum that we're going to do. Whenever we are doing questions, be it section A question or section B question. Now the paper pattern has already been discussed with you, and the paper pattern says that section A is of 50 marks and section B has 2 questions of 25 marks each. So total 3 questions in the complete AAA paper, and you're going to literally be judged on just 3 questions. Like the entire 2.5-3 months, you studied multiple questions, but the ultimate judgment is going to happen based on these 3 questions that you're going to do. So you need to prove to the examiner that you have done things well, you know things well, and you are capable to pass. Now whenever you're reading a question, you have to devote appropriate time to it. So the time that we have is 1.8 minute per mark, and this question is of 25 marks because we are doing section B. That means you have 45 minutes to do this question. Out of this 45 minutes, you have 5 to 7 minutes to read the question. So understand the question in this 5 to 7 minutes. Now how will you understand the question in these 5 to 7 minutes? What is the strategy? Strategy means there is no such the strategy differs from people to people. So I cannot say that like this is the strategy and everybody has to follow. But my strategy is something that I can share with you. Okay. So when you directly start reading the question from here, for example, Myron, it is 1 July 20x5, you are the manager, this, that. And when you reach the requirement stage, then you understand, acha, this is what you have to do. Okay, this is what you have to find out. And then when you read this, you forget the question. So you again go up, that you understand this is what they have told you to do. Then you again go up and read it again. So that wastes your time. So I always tell my students that start reading the question from requirements. So when you read the requirements first, you exactly know what to look for in the question. Because the question is very huge. The syllabus is very huge. So we do not know if this is an audit risk question, or this is a completion review and reporting question, or this is what category of question it is. So we don't want to waste our time in judging, okay, this might be this category or this might be that category. We do not want to waste our time. In order to save time, we will start from requirement, which will clear cut tell us, okay, this is what you need to do. After you read the requirement, you have an idea in your mind. Okay, they've asked me audit procedures, they've asked me reporting, they've asked me this, they've asked me that. Now keep those things in your mind and come and read the question. So that is going to prove more useful to you, rather than reading the question and judging in your mind what they're trying to say, what they're trying to prove, and then coming to the requirement will just waste your time. And we have like 45 minutes to complete it, and we have to complete it in 45 minutes. So for that, the first thing that you have to do is read the question. So when you look at the question, first go and read the question. Read the requirement. Now requirement A says, using the information contained in Exhibit 1, comment on the completion matters to be considered in relation to the issues described and recommend the further actions necessary before the auditor's report can be signed. Okay, so this is a question on reporting. Comment on the completion matters to be considered and issues described and recommend further actions necessary before the auditor's report can be signed. So this is on reporting. Evaluate the implications for the auditor's report if no adjustments are made to the financial statements. So I said that the management has 2 categories, 2 options. They can make changes, so the issue gets over there and there, or they chose not to make changes. So if they chose not to make changes, then how will this matter affect the auditor's report? So we have to guess if it is a material and pervasive matter, material and non-pervasive, or not material matter. Okay. Then next, using the information contained in Exhibit 2, describe the auditor's responsibility in relation to other information presented within the audited financial statements and comment on the matter arising from the extract for the chair's statement, and assuming no changes are made to the chair's statement, then evaluate the implication for completion of the audit report. So in short, we have two issues, one in Exhibit 1 and Exhibit 2. The first part, we have to explain the issue, comment on that and all that. And second part in both the requirements is you have to evaluate the implications of this on the auditor's report if no change has been made. So this part is on Exhibit 1 and this part is on Exhibit 2. Okay. So first let's read the entire question and then read Exhibit 1, answer requirement A, then again read Exhibit 2 and answer requirement A. So the things will be fresh in your mind. Myron, it is 1 July 20x5. You are the manager responsible for the audit of Myron Company, a listed company, and you are in the process of completing the audit of financial statements for the year ended 31 March 20x5. The auditor's report is due to be signed in the next few weeks. The company's principal operating activity is the publication of trade and specific journals. The draft financial statement recognized revenue of $108 million, and last year the revenue was $102 million. Profit before tax this year is $9.3 million, but last year the profit was $8.2 million. The total assets that we have are $150 million, and last year the assets were $149 million. Okay, so the following exhibits available below provide information relevant to the question. First one, completion matters, details regarding issues you have discovered during your review of the audit working papers, and second, the chair's statement, that is the chairman's statement. Management has provided you with an extract from the chair's statement which they intend to publish in the annual report. Exhibit 1 is the completion matters. This is Exhibit 1 on which you have to solve part A, and then this is Exhibit 2 on which you have to solve part B. So let's read Exhibit A first. Completion matters is your Exhibit 1. You are in the process of reviewing the audit working papers and have identified the following potential issues. Sale of divisions. Myron Company is at the advanced stage of negotiations to sell its scientific publishing divisions to a competitor. The divisions contributed revenue of $13 million and profit before tax of $1.4 million during the year to 31 March 20x5. The draft sale agreement, which is due to be finalized by 1st August 20x5, shows an agreed sales price after cost of disposal of $42 million. The division is a separate cash generating unit of Myron Company. None of the assets of the divisions are held under a revaluation policy, and depreciation is charged on a straight line basis over the determined useful life of the asset. The finance director of Myron Company has not made any disclosures with respect to the upcoming sale in the financial statements for the year ended 31 March 20x5, as he considers it to be a part of next year's accounting transaction. However, the division has been written down from its carrying amount of $45 million to its estimated value in use of $41 million in the financial statements for the year ended 31st March 20x5. Then first time adoption of IFRS 16 leases. Myron Company operates from a leased premises and additionally holds leases for printing equipments for journals. These leases are material to the financial statements. The company has adopted IFRS 16 for the first time this year and has adjusted the opening balances and equity without restating comparatives as permitted by IFRS 16. There is, however, no reference in the financial statement to the change in policy or the reasons for making the change to accounting policies. The adjustments have already been checked by the audit team and deemed appropriate. Now, on this first exhibit, what you have to do? Comment on the completion matters to be considered in relation to the issues described and recommend the further actions necessary before the auditor's report can be signed. Whatever are the matters that are discussed here regarding the carrying amount and the first time adoption of leases, discuss these matters and consider in relation of describe and recommend further actions necessary before the auditor's report can be signed. So before signing, what actions should be taken, and if evaluate the implications for the auditor's report if no adjustments are made to the financial statements, and how to address this issue. So this entirely the A part is for 15 marks. So I'm giving you just 2 minutes to go through this and then we'll start with the solution. What is the matter? First of all, matter is that the company is at the advanced stage of negotiations to sell its specific publishing division to the competitors. This is the matter. So now discuss the materiality of this matter and accordingly answer its effect on the auditor's report. So I told you the matter, now further you decide an answer. And how will it impact the auditor's report? So now in AAA you have to write a lot of content for the number of marks that are awarded. Okay, so there'll be a lot of theory typing, so you need to be really fast at typing. Then discuss the materiality of this matter by using the formula of materiality. I hope you remember the formula of materiality. 0.5 to 1% of revenue, 5 to 10% of profit before tax. Please read this also, Exhibit 2. We don't know if we might need any information from here also. So as a part of your review of Myron Company, you have also been presented with an extract from the draft chair statement which will be published in the annual report alongside the financial statements for the year. Extract from chair's statement, the company results from the year are extremely positive. Our year-on-year revenue growth is 5.9% and our profit growth is even stronger at 13.4%. All our revenue streams have performed well, especially the scientific publishing division, and we are looking forward to exciting and sustained growth levels again next year. As you can see from our auditor's report, the auditors agreed that our results are stronger and a sound basis for taking the company to an even greater place next year. We have made significant progress with our social and environmental aims of reducing our carbon footprints and encouraging reuse and recycling across our divisions. We are proud to announce that we have now moved all our printed products to recycled paper. To help with your review of the information, you also have the following analysis. So this is the analysis. This is for 20x5 and this is for 20x4. Other divisions revenue profit before tax, scientific publishing ka revenue and profit before tax, and total revenue and profit before tax. Again, for the previous year, other divisions profit and revenue and profit before tax. Scientific publishing divisions revenue and profit before tax, and total revenue and profit before tax. A file note from the audit supervisor states that at least 3 of the publications Myron Company sells are not prepared on recycled paper. So let's comment on the completion matters to be considered in relation to the issue described and recommend the further actions necessary before the auditor's report can be signed. And what is the issue in Exhibit 1? The sale of advanced stage negotiations to sell its scientific publishing division, and all the information relating to scientific publishing division's revenue and profit before tax is given here for this year and for the previous year. So using all that, stating the materiality, we have to answer this question. So let's answer the A part. Using information contained in the exhibit, comment on the completion matters to be considered in relation to the issues described and recommend the further actions necessary before the auditor's report can be signed, and evaluate the implications for the auditor's report if no adjustments are made to the financial statements. Before you read it twice. Before you answer it, read it twice so that you are not making a mistake in answering, because once you have typed the answer, then there is no scope of changing it, because we have already wasted so much time in typing the answer. Okay, so what you will do first, matters, further actions, and auditor's report, implications. It is what you have to discuss. First, I will discuss matters. What's the matter? Negotiations to sell the scientific publishing division, right? So write it in nice paragraph form, so it becomes a little attractive also. So matters, and go to the next line and say the company is at an advanced stage of negotiations. Advanced stage of negotiations with a competitor to sell its scientific publishing divisions currently. The finance director has not included any reference to the sale in the financial statements for the year ended 20x5. Then this is the matter that needs to be considered, okay, and we've clearly seen this matter in the question. So whenever there's a matter that is the sale of division, which is clearly given as a matter, you have to comment on the completion matters to be considered in relation to the issues described and recommend further actions necessary before the auditor report can be signed. So the implications clearly depends on if the matter is material or not. So the next thing that you will consider is the materiality of the matter. Okay. Next thing you will consider is the materiality of the matter. So this is the scientific publishing division. So the revenue of the scientific publishing division how much is the revenue? So the revenue of scientific publishing division is how much this year? 13 million. So the revenue of $13 million represents, you have to see the materiality of it. So represents how much percent of the total revenue? $13 divided by 108 into 100 will give you the percentage of scientific publishing revenue towards the total revenue. So on my calculator it is giving me 12%. Please cross check on your calculator as well. So the revenue of the scientific publishing division of 13 million represents of total revenue and the profit before tax. What is the profit before tax? Is 1.4. So 1.4 divided by 9.3 into 100 will give you 15.1. So the profit of the division, this profit before tax, represents 15.1% of profit before tax of total. So write that also. So the revenue represents 12% of total revenue and the profit before tax of the division of $, how much was the profit? 1.4 million. Represents 15.1% of profit before tax. Okay. Now materiality says 0.5% to 1% of revenue and 5 to 10% of profit before tax. So this is above that. So obviously this issue is material. So the division is therefore material to the statement of P&L. The assets of the division are also material as they represent. So now your assets percentage, if you take, I am getting 27% of the total of company's total assets based on their value and use, which is recognized in the financial statements. Now they want to sell off this particular thing, which is a division. Okay, so now sale of a division means sale of an aspect of the company. You're not selling the entire company but just a division. So assets held for sale and discontinued operation. So this becomes a discontinued operation. It is a division which is an operation which becomes discontinued. So first I will explain what is discontinued operation and classification of assets held for sale. So discontinued operation and classification of assets held for sale. So this is the way you need to present and have a proper communication and proper headings so that you get the marks. So now this was a discontinued operation because I'm discontinuing an operation of my business. But before classifying this as a discontinued operation, I have to give the definition of discontinued operation, based on which I can tell the examiner whether my discontinued operation comes in this category or doesn't come. So IFRS 5, non-current assets held for sale and discontinued operations defines or discontinued operation as a component of an entity which either has been disposed of or is classified as held for sale. And represents either a separate major line of business or a geographical area of operations. So it represents a separate line of business because it's a discontinued operation, it's a separate operation and is a part of a single coordinated plan to dispose of a separate major line of business geographical area of operation. Okay, now further describing IFRS 5, says IFRS 5 requires specific disclosures in relation to assets held for sale and discontinued operations, including that the assets are recognized as current assets and the results of discontinued operations are presented separately in the statement of P&L and the statement of cash flow. Okay. According to IFRS 5, a disposal group of assets should be classified as held for sale where management plans to sell the asset and the sale is highly probable. So when you are classifying an asset as a category of IFRS 5, you have to make sure that there are 5 points that we're going to read further. If you have done the SBR paper before this, you might know these points by heart. For my dear students who have not done SBR before and maybe this is your first professional paper, I will explain it to you. So whenever you're categorizing an asset as IFRS 5 as held for sale and discontinued operations, in the balance sheet, the asset will come under a separate heading and the heading will be IFRS 5. Now the reason there are so many rules and regulations for the asset to be classified as under IFRS 5 is because once the asset is classified under IFRS 5, no depreciation is charged. So in order to avoid companies to purposely classify their assets as held for sale so that they are not charging depreciation, there are certain strict rules, and after the strict rules are classified and after the strict rules are fulfilled, only you can classify the asset as held for sale. So the conditions which indicate that the asset, so that the sale is highly probable are so the first condition is management is committed to sell, management is committed to a plan to sell, then the asset is available for immediate sale. So management is 100% committed to sale. When you get a buyer, then you cannot change your mind saying now I don't want to sell. The asset should be available for immediate sale in a proper condition. An active program to locate the buyer is initiated. So you're actively looking for a buyer. The sale is highly probable. And expected to be completed within 12 months. then the asset is being actively marketed for sale at the sales prices reasonable in relation to its fair value. So don't just put any value for sale, put a proper reasonable value. And actions required to complete the plan indicate that it is unlikely that the plan will be significantly be changed or withdrawn. Now, related to your question, in respect of the scientific publishing division, management has decided to sell the division and a buyer has been found. So the advanced stage of negotiations would suggest that the sale is highly probable. As a result, important disclosures are currently missing from the financial statements. Which could mislead users with respect to future revenue, profits, assets, and cash flows of the company. Failing to provide information about the sale of the divisions could be seen as a significant omission from the financial statements. Especially given the materiality of the assets of the division, the company's assets as a whole. If you fail to disclose this important issue, then it will be a serious problem, because this is a material issue. That is why we discussed materiality first. First we discussed the matter, that is the issue. Then we discussed materiality. Then we saw what is a discontinued operation. Then we classified it as a discontinued operation, and then we said if you don't classify it as a discontinued operation, then what will happen? There is therefore a material misstatement as Scientific Publishing Division has not been classified as held for sale and its profit presented as a discontinued operation. And the necessary disclosures have not been made in the financial statements. Now, whatever assets are held for sale under IFRS 5, what is the valuation of them? So, the next paragraph we have is held for sale valuation. Okay. So, IFRS 5 provides further guidance regarding the valuation of assets held for sale. Prior to classification as held for sale, the disposal group should be reviewed for impairment in accordance with IS impairment of assets. Since once you put an asset in IFRS 5 category, the asset is not depreciated. Therefore, the first time you put it there only, you have to impair it and then put it. Okay. The impairment review would require the asset to be held at the lower of carrying amount and recoverable amount. Sorry, it will be held at the lower of carrying amount and recoverable amount, where the recoverable amount is the higher of fair value less cost to sell, COS is cost to sell, and value in use. Okay. In this case, the recoverable amount would be higher of fair value less cost to sell and value in use. 45, sorry, less cost to sell, and so that would be value in use is 41 and fair value is 45. 45 less cost to sell is 3, so 42. So the highest is 42. So in this case the recoverable amount would be $42 million, representing the fair value less cost of sales. Management has valued the disposal group based on its value in use at 41. As I told you, the value in use is 40 million, which means that the assets and profits are currently understated by $. I don't know why the screen is changing, but there might be some technical problem, so just bear with that. This represents %7 of profit before tax and is material P&L for the year. After classification as held for sale, non-current assets or disposal group are measured at the lower of carrying amount and fair value less cost of sale, which would continue to be $42 million. Depreciation ceases to be charged when an asset is classified as held for sale. As I told you, depreciation ceases to be classified. That is why most of the companies want to put their asset in that category so that the depreciation is not charged. Then further, they're planning to adopt leases for the first time. Okay, they're planning to adopt leases for the first time. So this is an adoption of and IFRS standard, which is a first time adoption. So it is like a change in your current accounting policy. So a little light should be shed on that also. So adoption of IFRS accounting policies permits a change in accounting policy where the change is required by a standard or interpretation or only in these two situations you can change an accounting estimate to introduce or adopt a new standard, where it is required by a standard or interpretation, or it results in the financial statements being more better. Providing reliable and more relevant information about the effects of transactions other events or conditions on the entity's position, financial performance or cash flow. Where the change in the policy is due to the requirements of a new standard, then the method of applying the change set out in the standard should be followed. In this case, IFRS 16 permits a lessee to either apply IFRS with full retrospective effect or alternatively not restate comparative information but recognize the cumulative effect of initially applying IFRS as an adjustment to operating, or rather to opening equity at the date of initial application. Okay. Therefore, the accounting treatment by Myron Company is acceptable. Okay. But you cannot directly state in one line that it is applicable. You have to state these points to say that the treatment is acceptable. However, that doesn't get over there. However, the lack of disclosure of the change in accounting policy is not in accordance with IAS 8, which requires the following disclosures in these circumstances. What are the circumstances? The title of the standard or interpretation causing the change, or the nature of the change in accounting policy or description of the transactional provisions, including those that might have an effect on future periods and for the current period, and each prior period presented to the extent practicable. The amount of the adjustment, again, the amount of adjustment for each financial statement line item affected and for basic and diluted earnings per share only if the entity is applying IAS 33. Only if the company is applying IAS 33, that is earning per share. Okay. So the amount of adjustments relating to periods before those presented the extent practicable, and if retrospective application is impracticable, an explanation and description of how the change in accounting policy was applied. And as these disclosures have not been made, there is an omission of disclosure which is a key to understanding the changes in deriving leases or lease balance in the financial statements, which is likely to be a material omission, because disclosure is equally important, given that leased asset are material to the financial statements. Okay, so what are the further actions that you will take on the same? The auditor should request the management adjust the financial statements to recognize the discontinued operations and to separately disclose the assets held for sale in accordance with IFRS 5 and disclosures in accordance with IS 8. These two things should be done. These are the further actions that are suggested. In addition, the client should be requested to amend the carrying amount of the assets to the recoverable amount of $42 million in line with IFRS 5 requirements. Then now if the management, the main part, if the management refuses to adjust the financial statements, the auditor should communicate the misstatement to those charged with governance. Should repeat the request and information and inform them of the impact on auditor's opinion if the adjustments are not made. Okay. If management still refuses to amend the financial statements, then what will happen? The auditor should request a written representation, because it serves as a proof. As I told you, orally nothing needs to be done. A written representation from management confirming their intent to proceed without amending the financial statements, and that they are aware of the potential repercussions. So basically, for those who were asking me that what should the effect be on the financial statements and what should you take from management in writing, so this is what you will take from writing from the management. And then the final answer, which is auditor's report implication. What will happen on the auditor's report of all this matter? So auditor's report implications. If the adjustments are not made, there is a material misstatement in the financial statements. Material misstatement in the financial statements. The matters above have resulted in an understatement of assets and profits by dollar which in isolation is unlikely to be pervasive as limited components of the financial statements are affected. So it is material but not pervasive. Means that mango is affecting only that mango, it is not affecting the other mangoes in the basket. This would result in a qualified audit opinion that is except for the material misstatement in relation to the valuation of the assets held for sale in the financial statements are fairly stated. So this is your auditor's report implications. Now after this, opinion is given. What about basis of audit opinion? So depending on the opinion provided, a basis for qualified or adverse opinion paragraph could be added underneath the opinion paragraph to describe and quantify effects of misstatement. Okay, so this is going to be your answer for an entire 15 marks. It should be looking worth 15 marks. From here you will start the matter, then materiality, then explain discontinued operations, then held for sale valuation, then adoption of IFRS 16, and then further actions, and finally the auditor's report implications. Okay. So please go through this answer. See the implications on the auditor's report. Now we shall take a break of 5 minutes and then continue with the B part. Okay. so now we're starting with the requirement B. Now for the requirement B, we have to read things again, because obviously we are human beings and we cannot remember so much. So using the information contained in Exhibit 2, now for requirement B, we have to see the Exhibit 2, and requirement B is of 10 marks. So you have to write it accordingly. Describe the auditor's responsibility in relation to the other information presented with the audited financial statement. After the audited financial statement, there is something called as other information. So about that, with the audited financial statements, and comment on the matters arising from the extract for the chair's statement, and assuming no changes are made to the chair's statement, evaluate the implications for the completion of the audit and the auditor's report. Assuming no changes are made to the chair's statement, evaluate the implications for the completion of the audit and auditor's report. Okay. So the first one is describe auditor's responsibility in relation to other information, and that. So for that we have to read the Exhibit 2. Exhibit 2, chair's statement. As a part of your review of Myron Company, you have also been presented with an extract from the draft chair statement, which will be published in the annual report alongside the financial statements for the year. Extract from chair statement. The company results for the year are extremely positive. A year-on-year revenue growth is 5.9%, and our profit growth is even stronger at 13.4%. All our revenue streams have performed well, especially the scientific publishing division, and we are looking forward to exciting and sustained growth levels again next year. As you can see from our auditor's report, the auditors agree that our results are stronger and a sound basis for taking the company to an even greater place next year. We have also made significant progress with our social and environmental aim of reducing our carbon footprint and encouraging reuse and recycling across our divisions. We are proud to announce that we have now moved all our printed products to recycled paper. To help with your review of information, you also have the following analysis of the results for the year. This is the analysis that we have also already used in our first part, and based on that you have to describe the auditor's responsibility in relation to the other information presented with the audited financial statements, and comment on the matter arising from the extract of the chair statement. So this is the chair statement that we read. So on that you have to comment. So this is the B part, which is for 5 marks. Okay, so now let's write about that. What is it? It is auditor's responsibility for other information presented with the financial statements. Now IIC 720, the auditor's responsibility, little bit of presentation. Requires the auditor to read other information defined as financial or non-financial information included in an entity's annual report. Okay. The purpose of reading the other information is to consider whether material inconsistencies between the other information and the financial statements or between the other information or the auditor's knowledge obtained in the audit. If the auditor identifies that a material inconsistency appears to exist or becomes aware that the other information appears to be materially misstated, the auditor should discuss the matter with management and, if necessary, perform other procedures to conclude whether a material misstatement of other information exists, a material misstatement of the financial statements exist, or the auditor's understanding of the entity and its environment needs to be updated. The auditor does not audit the other information and does not express an opinion covering the other information. The next They've said what are the matters that are identified from the chair's statement, that is the chairman's statement. So matters identified from the chair's statement. In this case, the chair's statement refers to strong growth in the year in particular. So you have to shed a little light on the chair statement. The scientific publishing division and suggest that the growth will continue in the current year. The scientific publishing division represented of revenue and 15% of profit before tax. So what is it? And there's a material component of the company. As a scientific publishing division, will be disposed of early in the next financial period. It will continue to form part of basis of revenue or growth, and the chair's statement could be considered misleading. Further, as a result of the disposals on a like-for-like basis, it is more likely that the financial statements for the year ended X6 will include, that is the next year, reduction in revenue rather than growth. addition, the remainder of the business has experienced a lower level of growth in revenue and profits in the period than the scientific publishing divisions. Okay. Revenue growth of continuing business is 2% compared to 44% in the scientific publishing division. Profit growth of the ongoing business is 5% compared to 100 for the scientific publishing division. Excuse me, guys. The chair has also made inappropriate reference to the view of the auditor. What's that view? Implying that the auditor's report validates this assertion. The statement also appears to be inappropriately preempt that auditor's report will provide an unmodified opinion is based on the assessment above may not be the case given material misstatement and lack of disclosure. This is inappropriate and all reference to the auditor's report should be removed. Now there is one more issue, if you have observed, is the use of the recycled paper. So in addition, there is also an issue with respect to the use of recycled Now what's that issue? The chair statement. In this case is consistent with the knowledge obtained during the audit, whether the auditor considers this to be material would be a matter of judgment because a lot of auditor matters are dependent on judgment depending on how many publications there are in total and the proportion using non-recycled paper, whether the issue may be material by nature rather than by size. This could be the case if it is perceived that there is a deliberate misrepresentation of facts which may be misleading to the users of the financial statements. So this is one more fact that needs to be considered. I'll put it entirely on the next page. Okay, so this is the entire fact. And then if you see the question, this part. Now the 5-mark part is done. Assuming no changes are made to the chair statement, evaluate the implications for completion of the audit and the auditor's report. So no changes to the chair statement. Implications for completion of the audit. Implications for completion of the audit. So, auditor should discuss with management and the chair the information in the statement which appears inaccurate or inconsistent. In particular, this should focus on discussion of the misleading growth analysis, given that the scientific publication will not be contributing to company's performance once it's sold. In the case of incorrect disclosure, relating to the use of recycled paper, the auditor should seek further information to support the file note regarding publications not using recycled paper. The names of those publications should be obtained and a discussion held with the production manager to confirm auditor's understanding. Following these investigations and discussions, the auditor should then request that any information which is inaccurate inappropriate or inconsistent is removed or amended in the chair's report, because the chair's report cannot be misleading. So in the chair's now, if the management obviously refuse to make changes, then the auditor's report should escalated those charged with governance. If the issue unresolved appropriate action. The auditor should take action, including what actions can he take? Considering the implications for the auditor's report and communicating with those charged with governance. About how the auditor plans to address the issue in the auditor's report. And next, withdrawing from the engagement where withdrawal is possible. So either make changes or withdraw under applicable law or regulation. And then how will it affect the auditor's report? So implications for the if the auditor doesn't leave. Auditor's report. So how will it if other information remains uncorrected, the auditor would use the other information section of the auditor's report to draw users' attention to the misstatement in chair's statement. The paragraph would include a statement that management is responsible for other information. One, then a statement that the auditor's opinion does not cover other information. Then a description of the auditor's responsibility and a statement that describes the uncorrected material misstatement of the other information. So as the inconsistency of in the chair's statement rather than the audited financial statement, the audit opinion is not modified as a result. Okay, so this is the entire answer for 25 marks. Now this is the what you can say answer that you should look up to. Obviously you can write it down in your own words, but your own words should not be very generalized, because ultimately this is advanced audit and assurance and this is a professional paper, so certain aspects should be there. Obviously you can write it down in your own words, like if I want to write this, so I can write it down in my own words, which will be a little shorter, but this is the expected answer. You can always write it down in your own words, you can always twist and turn it, but the presentation, the matter, materiality, it should be clear and to the point. Okay, so this is what is exactly expected of you to write for 25 marks. It can be a little shorter also, obviously, not so long, but this is the ideal answer, you can say. So this is what an ideal answer can give you marks. You can twist and turn and write it down in your own words. Okay, so now before moving to question 2, we take a break of 5 minutes and then proceed. So that was the first section B question that we solved. Now the second section B question that we're going to solve is Goodman Group. And again, the instructions remain the same. You have to read the requirement first and then come to the question. So the bigger the question, the better it is. Again, using the information contained in Exhibit 1, discuss the implications of the fraud with the completion of the audit and the actions to be taken by the auditor. In respect of the development cost and trade receivables, comment on the sufficiency and appropriateness of the audit evidence obtained. Recommend the actions to be taken by the auditor, including the further evidence that should be obtained. And using the information contained in Exhibit 2, critically appraise the extract from the proposed auditor's report of Goodman Company for the year ended 31 December 20x4. You are not required to redraft the extracts from the auditor's report. So let's read the question. It is 1 July 20x5. You work in the audit department of Saul and Company. The Goodman Group, the group is an audit client of your firm, and the audit for the financial statement year ended 31 December 20x4 is in the completion stage. The group, which is not listed, installs and maintains security systems for the businesses and residential customers. Materiality for the audit of the group financial statements have been determined to be $4 lakh. The following exhibits available below provide information relevant to the question. Completion matters detailed regarding the issue have discovered during the review of audit working papers. Draft auditor's report and supplementary information. Exhibit 1. Completion matters. What is the fraud? The group finance director has informed the audit team that during the year a fraud was carried out by a manager, Mike Trout, in one of the group's procurement departments. The manager had raised fictitious supplier invoices and paid the invoiced amounts into the personal bank account. When questioned by the group's finance director, Mike Trout confessed that he had stolen $40,000 from the group. The finance director asked the audit team not to perform any procedures in relation to the fraud as the amount is immaterial. He also stated that the financial statement would not be adjusted in relation to the fraud. The only audit evidence on file is a written representation from the management acknowledging the existence of the fraud and a list of the fictitious invoices which had been raised by the manager, provided by the finance director. The audit working papers conclude that the fraud is immaterial and no further work is needed. Development cost. In August 20x4, the group commenced development of a new security system and incurred expenditure of $6 lakh up to the financial year end, which has been capitalized as an intangible non-current asset. The only audit evidence obtained in relation to this balance is as follows. Agreement of a sample of the cost included in $6 lakh capitalized to supporting documentation such as supplier invoices. Cash flow projection for the project, which indicates that a positive cash flow will be generated by 20x8. The projection has been arithmetically checked. A written representation from the management stating that management considers the development of this new product will be successful. You're aware that when the group finance director was asked about the cash flow projection which had been prepared, he was reluctant to answer questions, simply saying that the assumption underlying the project had been agreed to assumptions contained in the group's business plans. He provided a spreadsheet showing the projection, but the underlying information could not be assessed as the file was password protected and the group finance director would not provide the password to the audit team. Trade receivables. Trade receivables recognized in the group's current assets includes a balance of $5 lakh relating to a specific customer, Hamlin Company. Audit procedures indicate that at 31 December 20x4, the balance was more than 6 months overdue for payment. In relation to this balance, the following procedures have been performed. Agreement of the balance to invoices and original customer order. Discussion with the group credit controller who states that we are in discussion with Hamlin Company and we are confident that some or all of the amounts due to us will be paid. We have always allowed this customer extend credit terms and they have always been paid eventually. Hamlin Company was included in the trade receivables direct confirmation audit procedure, whereby a sample of customers were asked to confirm the outstanding balance but no reply was received. Then this was regarding the first requirement. Then Exhibit 2 states, and that is a whole new exhibit altogether. So it is used for section B. So we'll read it when we are doing B part. Now for the A part, first one, we have to discuss the implication of the fraud for the completion of audit and the actions to be taken by the auditor. So let's do it first. So if the full extent of the fraud is $4 lakh, then the audit team is correct to determine that the fraud is immaterial to the financial statements. However, without performing further procedures, it is not possible to reach that conclusion. There is no auditor generated evidence to support the assertion that $4 lakh is the total amount of stolen funds. Relying solely on a conversation between the group finance director and the manager who carried out the fraud, and the list of invoices provided by the group finance director is not acceptable, as this evidence is not sufficiently reliable. Indeed, the group finance director could be involved with the fraud and is attempting to deceive the auditor and minimize the suspected scale of the fraud in order to deter further procedures being carried out or investigate actions being taken. Okay. The auditor should approach comments made by the group finance director with an attitude of professional skepticism, especially given that he has asked the audit team not to investigate further. Which raises suspicion that he may be covering up, right? The fact that the fraud was on a larger scale then has been made known to the auditor. There are two courses of action that the auditor can do. For the auditor, first, investigations should be carried out in order for the auditor to obtain sufficient and appropriate audit evidence relating to the amount of fraud this is particularly important given that the group finance director seems unwilling to make any adjustments to the financial statements. If the fraud is actually more financially significant, the financial statements could be materially misstated. but without further audit evidence, the auditor cannot determine whether this is the case. This is the first thing that the auditor will do. What is the second? Second, the auditor should consider whether reporting is necessary. The relevant IIC requires that when the fraud has taken place, auditors shall communicate these matters on a timely basis to the appropriate level of management in order to inform those with primary responsibility for the prevention and detection of fraud of matters relevant to their responsibilities. Given that the group finance director alerted the auditor to the fraud, it seems likely management and those charged with governance are already aware of the fraud. However, the auditor should consider whether a formal written communication is needed. Okay. And then in addition to reporting to management and those charged with governance, ISA 240, or you can say the appropriate ISA standard, requires that the auditor shall determine whether there is a responsibility to report the occurrence or suspicion for party outside the entity. The auditor's duty to maintain the confidentiality of client information makes such reporting potentially difficult and the auditor may wish to take legal action or rather legal advice before reporting externally. So this is the answer that you're going to write for the first part, which is for 6 marks, and this 2 together is for 11 marks. This is the 6 marks answer. As I told you, obviously you can twist, turn, and when you write it in your own words, automatically it's going to become a little small. Okay, when you write it down in your own words, automatically it's going to be a little small. One second now. So that's with it. And so when you write it down in your own words, it will become automatically smaller because obviously you cannot by heart so much. But when you write it down in your own words, please remember that don't use a very generalized language, because here you're doing advanced audit and assurance, which is again an ACCA professional paper. So you'll be judged on professionally, and in the first lecture it's already discussed what the professional marks are for. Now this is an old question, so it doesn't have professional marks, but now you know that from this attempt onwards, from September 2022, there are 20 marks professional. So the paper ideally is for 80 marks, so things are going to be easier, and gaining professional marks is doing all of these. So please go through the answer, and this part we will do tomorrow, okay, same time, and then we'll continue with the other section B, sums. Okay, so please go through it, and that's it for today.